The cost of capital for renewables projects are driven by primarily macro forces that are driving the wider infrastructure investment market, to be honest. The things that are driving that wider market are overwhelmingly the rising commitment of investors to infrastructure and energy as an asset class within their broader portfolio. And to give you a sense there, maybe a typical allocation, a typical target allocation in, say, US pension funds is 4 to 5%. They've probably got their actual levels to in the 2 to 3% range, so they're playing catch up. Whereas for investors like the big Canadians who've been in this space for decades, they're pushing up towards 12, 13, 14% allocation. So you can see which way the trend's going, and that's just on existing volumes of capital. When we then take into account the rising volumes of capital that there are in pension funds and other investable pools of capital around the world, there's exponential growth in the volume of capital coming into these markets. Looking at them generally from an equity perspective, though not exclusively. Turning to the debt side of delivering capital to these projects, the fact is that these projects very much are subject to the forces that create or restrict liquidity in bank project finance markets. When banks are looking positively on the opportunity to get long-dated exposure to high-quality assets, then that's a very good thing for this asset class, and indeed that's been the trend for more than half a decade now. But when that reverses, and at some point I guess it will taper off, then that will make it just that little bit harder to raise efficient capital for these projects.